Hello, everybody. Today we have a very special guest into our investing podcast. We're talking with Jack Vogel from Alpha Architect. Hello, Jack, and welcome to our first Q&A session.
Thanks, Victor, for having me. Glad to be on. And you've been reading a lot of our the articles on our website and reaching out with a ton of good questions. So figured we just chat and answer some more questions for everyone.
Yes, exactly. And especially because here in Romania, there aren't very many people who can answer these questions from an academical point of view. And I respect very much your work, also Nicolas Rabener's work, another specialist in this field. And I would like to offer insights from this industry to people in Romania who would like to invest and construct good risk-adjusted returns portfolios. So how are you? It has been a hell of a year, 2020, for the investing business, right?
Yeah, definitely. I would say, one of the things that's definitely interesting is if you go back and read everyone's 2020 predictions from all the experts. I'm sure no one probably had that.
At the beginning of this year, Bob Prince from Bridgewater Associates was talking at Davos about the end of the boom-bust cycle. But then the coronavirus black swan event hit and volatility spiked like never before. Which are your rational expectations for volatility in terms of standard deviation for market cap index funds, FTSE World, and emerging markets? So he was telling at the beginning of the year that we wouldn't see any volatility for the coming years.
That we would not see any?
Yes. He said that it's the end of the boom-bust cycle, and then the volatility erupted.
Yeah, it's that's why it's tough for people to predict anything. I still remember it was a couple. I forget the exact year, but sometimes one item people like to predict is treasuries, like U.S. treasuries in the next year, and I think it was like I forget which publication, but it was like 40 out of 40 economists all said that interest rates were going to go down, and then they went up, 100%. So it's just crazy. It's hard. Financial markets are hard to predict, which is a good. If nothing else, your viewers should learn that.
Yes, but is there any correlation between, let's say, interest rates and stock market valuations? Because I've listened to Robert Schiller, who was saying that although markets are expensive, since interest rates are low, they can still offer some good returns. But in the same time, if the interest rates, long-term interest rates are high or start increasing, then that would be a signal for market timing. So expensive equities with increasing interest rates would signal that we should go out from equities and go into bonds. Do you believe into this market tie-in signal? I know that you are a believer in value equities, but in the same time, you don't believe in market tie-in signals for entering value stocks.
Yeah. So what I'd say is on like interest rates relative to like multiples, right? There probably is some relationship. And why would there be some relationship? Well, let's just think about this. If you take earnings multiples, right? So let's pretend that the earnings multiple on the market is 20 for simplicity. So 20 times earnings, the PE multiple. Uh-huh. So if you invert that, what you can get is the effective earnings yield or the implied earnings yield on the market, which will be 5%. Uh-huh. So now as an investor, if your default other option is to buy, safer bonds at 1%, or you can get an earnings yield at 5%, people will look at that risk reward trade-off, uh-huh. Right?
So it's an opportunity cost, right?
Yeah, it's a very simple way to assess at any given point in time the opportunity cost, or basically what is the expected extra edge on stocks relative to bonds, right? And at times it can vary. So if you go back into like one of the worst periods for U.S. stocks happened to be like the 2000 decades. But people forget that going into December 31st, 1999, it was actually the opposite, right? Whereby the earnings yield on U.S. stocks was lower than U.S. Treasury bonds, right? So if you bought stocks relative to bonds at on December 31st, 1999, you were effectively expecting ex ante to earn less on stocks than on bonds,
Exactly.
right?
Yes.
So there should be,
That was
the
peak of the dot-com bubble, right? In
yeah.
1999.
Mm-hmm. And, there is like a neat little paper called Fight the Fed. Cliff Asness wrote an article of AQR called Fight the Fed Model. And the Fed model effectively looks at this relationship between stocks and bonds and had to go back to, I think Greenspan made a comment about, this relationship between multiples and yields. And in the article, what it kind of found was, the Fed model is good at describing like what the current market PE is, right? Because effectively when interest rates go lower, PEs may go a little bit higher, but it's not that great at predicting future stock returns. So that's the caveat with it, right?
This earnings yield takes into consideration both capital growth and dividends. Here in Romania, many people think that if you simply invest in high dividend stocks, you would get a higher return. But I know from Nicolas Rabener that it doesn't matter if a stock offers or doesn't offer dividends, and this also can be applied in real estate, where it is that concept of gross yield. Also, a lot of people in Romania, I think 99% of Romanians, concentrate their portfolio into illiquid assets from private equity markets such as real estate, because the gross yield on real estate is the highest in Europe, and also we have the highest dividend in the world, I think, or we had in 2019. But that can also be a value trap, because with an aging population, if you don't have any growth, right, only total return matters in the end. So if we were to invest into individual equities or individual real estate for, I don't know, hoping for higher returns, which would be the most relevant indicators to look at? So is gross yield or dividend yield relevant at all? I don't know.
Yeah, so let me go back to, do academics consider dividend yield to be an important factor? And at least, in the U.S. and U.S. market, as well as other markets, they generally don't include dividend yield as a factor or something that you could tilt towards. Now, there's a couple of reasons there, right? One reason is there just happens to be an issue of a lot of firms in the U.S. don't offer dividend yields, right? And so if you're trying to run what's called like cross-sectional tests, where you're looking for a variation of returns across metrics, right? You have this issue on dividend yield that's kind of unique to dividend yield, where you have like, you have variation of like low yielders to high yielders, but then you also have this bucket of no yielders, right? And that just causes issues from statistical testing standpoints, right? Whereas if we want to look at value versus growth, you can take, for simplicity's sake, the PE multiple and say the super high PE firms, those are growth firms. And then you have down to the very low PE firms, those are value firms, right? So you get what's called more like cross-sectional dispersion. So the way I generally think of dividends and dividend investing is, that effectively is just a decision for management for how to return capital, right? So they are determining that they're going to return some of the capital in the form of dividends to shareholders. That generally signals a couple things, right? It generally signals because, for at least in the U.S. stock market, if you start a dividend process, one of the worst things you can do is to cut it, because the minute you start cutting dividends, like your stock usually tanks, right? Yeah. So what that means is the CEOs or the upper management, including CFOs, et cetera, believe that there's like sustainable earnings for the firm that they can give out to investors. So if you're specifically going to be a dividend investor, one thing you probably want to look at is just like you want to make sure the firm is still growing earnings, and basically how much cash flow is the operations of the firm generating, and is that sufficient to cover the dividend yield, right? Like in the U.S., actually, and this happens, I'm sure, in other markets as well. But there sometimes become risky dividend plays where firms are almost like issuing debt to pay dividend yields, right? So you want to make sure that if you were specifically going to be a dividend investor, a simple metric to look at is called like the payout ratio. Like how much of the earnings is the firm paying out on dividends? The lower the payout ratio, the better.
Yeah, in Romania, we have the government who owns the most majority of stocks in the market, and he needs money, so that's why the payout ratio is high. But I don't know. In the end, I think what matters is the earnings yield, and not if a company offers or not dividends. This is only for your mindset. The same thing with real estate. People don't see volatility because we don't have a secondary market, and they prefer to not know about price fluctuations and only think about earning that rent. Okay.
Yeah, it's true. And, that's why, interestingly enough, generally real estate, it's funny when you said that exact thing. It's a very behavioral bias that people have, because in their mind, if you own a house, and even if the housing market in the local area in which you own one house, which again is a little dangerous, you're taking an idiosyncratic one house bet, but even if it drops, if you don't, in most people's minds, if you don't sell,
Yes,
you haven't realized the price loss, but you really have, right? But it's yeah, so
in Romania is insane. 96% of people have own a house, but they don't own any liquid assets. So they are cash poor and illiquid rich, let's say. And most of them engage in pro-risk behavior, buy 6, 7, 8 houses on credit because this is what they heard from Robert Kiyosaki, because cash is trash, savers are losers, and it's better to have no assets and only debt because debt is good and you make a lot of money from debt. What do you think about this?
well, I think that's where you want to just probably understand all the laws on what happens if you take on too much debt, right? Generally, too much debt can be financially painful, but it does vary from state to like in the U.S., right? And I'm not 100% sure of the Romanian market, but there are certain states in the U.S. where you can buy a house and it's called non-recourse debt, right? And the only reason I bring that up is, and again, I have no clue if this is what the case is in Romania, but an interesting thing is, in theory, you could buy a house. Let's just say you had $1 million, you bought a house, but you only put 5% down, so 50,000. Well, in some states in the U.S., even if you defaulted on that house, that let's just say the house was $1 million, if you only put $50,000 down, since it's called non-recourse, the bank, lenders, creditors can't come after you for any more than what you had already put in. They can just take the house, right? So I would say just make sure you're aware of the debt, what happens in debt issues, because that's where people, leverage is good until it's not good. And when it's not good, then, you can get yourself into a lot of financial trouble.
Yeah, but leveraging a concentrated portfolio for me is not risk-wise, let's say.
Yeah. Well, I'd say you just want to understand all the details on the debt side is what I would say.
Which do you consider being the best asset class for the next decade in terms of return to risk ratio? Because everybody discusses only about returns, but risk as measured by volatility is also relevant. We know that higher volatility assets are expected to bring higher returns due to higher risk, but they are not a free lunch, so we should be compensated for taking higher risk. Many people consider global equity markets as expensive and would like to diversify away from US. Will this offer them higher expected returns, albeit higher volatility, or also better risk-adjusted returns?
Yeah. So what's the question? The main question you want me to answer there?
The main question is whether diversifying away from US markets would offer us a better return to risk ratio at portfolio level, or only higher returns with higher volatility. So basically, we don't win anything.
Yeah, that's unfortunately, well, as we talked about, the first thing we said, predicting the future is almost impossible, right? So with that caveat, the one thing that's generally true is that you can measure, at least historically, is like volatility on different markets, different asset classes are generally pretty stable across time, especially over like a decade time period. So what is true is US is generally a little bit less volatile than international, which is generally a little bit less volatile than emerging. So the one thing, if we're attempting to figure out what the future would hold, I think a default good assumption that you can make is that the standard deviations historically are the same, right? So your denominator in your Sharpe ratio you can kind of predict that pretty accurately. Now on the expected returns, here's where expected return models vary across the way that they get built, right? So like a very simple expected return model is just looking at like dividend yield plus expected earnings growth rate yield, right? And if we look at that very simplistic model, right, which assumes, again, no reversion changes in earnings multiples, what you see is US is definitely low relative to international and emerging, but there's actually not like a massive divergence, right? Where you get massive divergence on expected returns is when you impose some mean reversion on multiples of earnings, right? And that's the hardest thing really to predict because, the market is going to do what the market's going to do. They're going to reward certain firms with high multiples, certain countries with higher multiples. And so if you expect there's going to be some mean reversion in there, then yes, it's probably the case that international is going to do better, both on an absolute and a risk-adjusted basis, but that's probably the hardest thing to predict in the future is there going to be mean reversion on earnings multiples? And if there is, at what level does it go towards, right?
Yes. There is also a paper, I don't remember exactly how it is called, which says that countries with higher GDP growth rates have actually lower returns from equities from I really don't remember. I just discussed with Nicholas Rabner about it. Jay Ritter wrote it, I think.
Yeah, it's a Ritter paper from a long time ago.
Yes.
We wrote a blog post. It basically just showed. I think on our website, the title of the blog post is "Turn Off Your Chief Economist." Like, let me just search it real quick.
The idea was for emerging markets. Many of them have a lot of expected GDP growth. India, Vietnam, a lot of countries, around 6-7%. China as well. So when I read that paper, it confused me. So basically, countries which are growing faster are not offering prospective returns for investors. So basically, only value matters, and even for value, we don't know if you have mean reversion because there are people who discuss about, let's say, Turkey or South Africa as countries that might have lost their fundamentals. So basically, they may be value traps. And how do you identify if they are traps or not? Except for diversification, of course, which always helps.
Yeah. I mean, so yeah, and the blog post is called "Turn Off Your Chief Economist." GDP growth doesn't predict stock returns. And yeah, I mean, effectively, it basically just highlighted that GDP growth and stock return relationships is kind of, there's really like no statistical relationship there. And who knows, like, again, that's a tough thing to try to like accurately predict, right? Because we're also in a different state of the world where there's global economy, and let's just say even if a certain country is growing from a GDP standpoint, they may be growing from a GDP standpoint, but they're generally using products and services from other maybe more developed economies, right? So effectively, what are you doing there? You're just effectively taking that GDP growth and moving it towards the stock market in another country, right? So I don't think there's a 100% relationship in a global economy between them. Maybe if we were talking about this where every single country had their own unique thing and every country had their own Google, their own Amazon, etc. In that scenario, there may be a better relationship, but we have to remember we're in a global economy. So,
okay. If you were to buy one single instrument for the next decade, which would that be and why?
One single instrument. Yeah. So I probably would, for one decade, it would probably be like something international, to be quite honest with you. I just think the expected returns on international stocks relative to U.S. stocks, if I had to take a bet for 10 years, it would be international stock market. I don't want to list specific ETFs because that could cause issues on our side, but probably just if.
Unfortunately, in UCITS format, we don't have MSCI EAFE or something like that. We only have either European equities or of course emerging markets. There is also a Smart Beta ETF from Franklin Templeton which has a good geographical diversification, but an asset under management of only about $50 million. So this might be a risk because we know that JP Morgan has closed the managed futures and long-short factor exposure ETFs this year, probably because of low asset under management. And I wanted to also ask you how this impacted the business during the sell-off in March. These sectorial funds do have issues for liquidity issues, especially.
Like long short type strategies.
Yes, long short and managed futures have been closed from JP Morgan. I don't know why, but I suppose because people were not engaging into them.
Yeah, I mean, I can't speak for JP Morgan specifically, but one thing that's generally true is a lot of product providers out there, if they don't get a lot of scale or interest into the funds, they generally end up closing them. And when we think about, the strategies you just mentioned, one of the biggest, hardest things on those two strategies is understanding the behavior, the investor behavior has to really be, I would say, super locked tight on understanding the bet and really not comparing those returns to the market, right? Because long short returns, right? Like from an academic standpoint, there's the value premium and the momentum premium, and that's technically a long short factor portfolio where you go long value stocks, short growth stocks. Momentum, you go long high momentum, short low momentum. And so the reason it's called a premium and an anomaly and a factor at the end of the day is because effectively when you're long stocks, short stocks, you have no market exposure, yet you still have a positive return. So, but even though we know you technically have no stock exposure in these theoretical long-short portfolios, and even in real-world long-short portfolios, investors will still compare that return to the market. And that becomes an issue, right? Because you effectively said, I want to take a bet that has no market exposure, but then you compare the returns on the no market exposure portfolio to the market. Well, that makes no sense, right? And so what happens then is investors will leave that strategy. The exact same thing happens on managed futures, right? Because effectively people say, I want diversified returns. I don't want the market return. But then they're like, oh man, the U.S. stock market's gone up for 10 straight years and this managed futures thing's done nothing. And the answer is,
it's something different between being uncorrelated and inversely correlated. So managed futures, I've tested the correlation and it was 0.3 or something like that. So it wasn't inversely correlated. Like people want inversely correlated assets, but we don't have any in these markets.
Yeah, well, managed futures, I think the goal in general is to have, a super high negative correlation when the markets have stress events, right? Because that's the actual goal, is to basically have something that offers portfolio diversification in the event that your buy and hold equity has a severe drawdown, right? So over long time cycles, you'd expect the correlation, hope it's like low, negligible, right? But the real thing on them is you want to look for these like high negative correlations and stress events. So you want to go look at like 08, 09. How did it do then? How did it do in late February, March of this year, right?
Yes,
And if you don't see negative correlation, then it's probably not a good product.
in most bear markets, I think it had negative correlations. I mean,
Mm-hmm.
it increased in value. The problem is we don't have any alternatives right now for managed futures. Uh, at least I couldn't find. Also, I couldn't find for small cap value ETFs because, uh, and this is another topic, very important topic, because many people invest in small caps because they think there is a small cap blend premium. I'm not sure if it is because there are small cap growth stocks with weak profitability that affect the premium for the asset class. So if you don't have any small cap value in its format, it's a pain, let's say. And also, we don't have any possibility to capture the long active volatility as retail investors. So all the uncorrelated return streams are not available to us. What can we do? What kind of diversifier would we need in a portfolio? Some people invest in gold, other in crypto. Uh, I don't know. I know that these assets have no internal rate of return, so basically are only a speculation. So even Jack Vogel said some time ago that he wouldn't add even a 3% gold in his portfolio because it's a speculation, while others would use gold as an uncorrelated return stream, even though it brings no uh, expected return on the long term. What do you think as a young retail investor? Do we have any good diversifier to add in our portfolios?
Well, the simplest one, and again, this is speaking from a U.S. investor, right? So you got to take that for what it is. But the one asset class in the U.S. that has worked well for the past 40 plus years has just been U.S. Treasury bonds, right? You don't have to go crazy on duration. I would just do 7 to 10. You could go further out, but in general, for the past like 4 to 5 decades, whenever there has been any equity stress events, the U.S. Treasury bonds have generally been the deflation flight to quality asset, right? And you see that earlier this year. I've spoken about this topic with a lot of U.S. advisors, because one thing that's interesting is within the bond market this year in March, right? You could have went across the credit spectrum, and really the only thing that did really well were U.S. Treasuries. Like U.S. Treasuries were up, like 10, 15%, looking at the 7 to 10 year area on duration. But corporate bonds were down. High yield bonds were down a ton.
Mm-hmm.
Municipal bonds were down even more, right? Because they were afraid like states and governments were going to go bankrupt. So treasuries are one potential source. Now, of course, there's an issue with treasuries, which is you could also get the weird, and this is just, things can change, right? You can get the event possibly in the future whereby the U.S. Treasury doesn't work well in a stress event, and that's probably going to be an instance if you like think through, well, what would happen if the U.S. Treasury wasn't a good asset class, right? So that probably means either it's not the flight to quality asset, which you have to figure out another one, but that's going to be hard. Or the alternative is it's not a deflationary asset, right? Which means you'd have an inflationary type shock to the market. And so if you have an inflationary type shock, well, what are some things you could do there? Well, that's where you can look. That's why, some people do like gold, because it is like an inflation hedge, right? Now, equities, just to remind everyone, are a better inflation hedge than bonds. But what I'd say is, like a lot of managed futures, even when you think about it from a big picture.
one second, Jack,
Yep.
because you mentioned stocks, and I wanted to ask you, except for stocks, do you think that a retail investor should have a different hedge against inflation?
So I don't think again, you want to keep the portfolio, I would say, simple from the outset, just because, and simple is always better because people can stick with it, right?
Yes.
Like there are a ton of investors in the US who just went to Vanguard, bought the market, and have done really well, right? Because they don't think about it. So we always want to caveat that, but hyperinflation would be like one of the big issues you could get concerned about. And if you're concerned with that, yes, then you would want to look at asset classes that you would think possibly could do well in hyperinflationary type environments, right? Like gold potentially could do well, right? Crypto could do well if you believe that crypto would be like the new digital gold that would go up a lot with inflation. So again, I'm not proposing you use either of those, but there are just some logical ways to think about a portfolio, which is that, if you wanted to protect your portfolio from inflationary hedges, there are a couple ways. But again, do want to caveat, remember that stocks are different than bonds, and stocks have a better ability to protect against inflation than bonds do, right? Why? Because if you buy a bond, like let's say, you have a 10-year bond out there and there's a ton of inflation. Well, if there's a ton of inflation, that means interest rates are going to rise, right? Which means you're going to get hurt from a price standpoint because your bond that you bought, let's just say today at 1%, the new yield's going to be 3%, right? You're going to lose on that, right? On the price movement.
Can the global economy service debt with higher interest rates today? That's the question.
Yeah, I mean, it might not be able to, but I'm just saying if interest rates rise to combat inflation, right? You would get hurt as a bond investor, whereas as an equity holder, right? Like think of it from a CEO perspective. Let's just say there's a ton of inflation and you're a CEO making widgets. And you and your CFO have determined that you want to have a 20% profit margin, right? So if your input costs went up 20%, well, you're just going to have to charge higher output costs, right? Yes. And as long as you can keep that margin pretty similar, the stock owner, which owns rights to the residual cash flows and the cash flows that the company makes, is still going to be pretty well. So stocks in and of themselves are a decent inflation hedge, is what I would say.
I would like to ask you, what do you believe about large cap growth stocks? Since we know that quality and minimum volatility usually have lower drawdowns, while value equities have higher drawdowns. So can we see expensive assets to be actually safer in terms of drawdowns at portfolio level?
So it is possible if the more expensive stocks happen to be super high quality stocks, right? In that unique exact circumstance, which in some instance you could say some of the super expensive tech stocks in the US are pretty high quality, which they actually are if you look at like ROA, ROE type metrics. So that is probably a true statement that could happen in that scenario where the expensive stocks happen to also be high quality stocks, right? Which, historically in the past, that wasn't generally the case, but in this scenario, at least as of now, it seems to be the case.
Which factors do you believe are best positions to outperform during the next decade in both developed markets and emerging markets?
Developed and emerging. I mean, I'll probably always default to just value and momentum, to be honest with you. I just kind of think that those are of the factors, the two, if I had to hitch my wagon to something for a long time. Momentum is the very simple process of just buying whatever's done well. And, but momentum investing takes rebalancing, right? So that's one of the downsides, or not downsides, it's just a fact, right? As a momentum investor, you can't buy this portfolio, hold it for a year, right? Whereas value investors, in general, value still works out to a year or even a couple of years, which is buying cheap stocks on a relative basis. But I'd probably just default to those two factors, as I think that they're probably two of the most important factors.
If you diversify across factors, would you still have a positive risk premium, or some factors are very expensive and might bring us negative returns?
Yeah, well, so let me think about that.
Because we have smart beta products, multi-factor there.
Mm-hmm. Oh, okay. So like within a multi-factor
Long only
strategy. Yeah. So I mean, in there, what's going to happen is it becomes hard in multi-factor to kind of ascertain like what's exactly driving the return, because the construction of that process is going to deviate. The construction of that process will kind of end up overweighting certain factors, underweighting other factors, right? You would, in theory, still predict that multi-factor over long time cycles should do pretty well. So that's generally a good way to build a portfolio.
Even in long only format and not long short?
Well, again, so remember, like long short, like the reason long shorts is an anomaly, and people, like, I think investors sometimes forget this, is long short's an anomaly because the idea behind it is you can buy the market, right? So if you had $100, you would go buy the market for $100. Then in academics, they would say, okay, in addition to buying the market, you can now buy $100 of value stocks. So you borrow money to do that, but then you short $100 of growth stocks. So now you're getting the market return plus this long short premium, right? And so, you could, in theory, just do long short investing. The problem again with that is you're going to not now have any access or no investment into the market. So a long only product is definitely going to have a beta close to 1 relative to the market, but you're effectively just saying, I'm going to take the market portfolio and tilt it. Besides market beta, I'm going to take other bets, like I'm going to take a value bet or a momentum bet.
Yes, but long only factor tilted ETFs, I know that have higher drawdowns than a combination between beta and long short.
Well, that's probably true, right? They're going to have higher drawdowns because, so let's just take, I mean, it depends on which long short we're talking about, but let's just assume we're talking about like quality minus junk, right? So quality minus junk, like the AQR factor, which is basically buy high quality short junk stocks, right? We already know in every single equity drawdown, this thing does really well, right? Because you're effectively going to be long the high quality firms, you're shorting the junk stocks that do really bad. So if you take a long equity market position, add in long short quality minus junk, when equity markets go down, your quality minus junk is going to go up. So from a portfolio perspective, that's going to do better. That is true than just a factor portfolio that's long only, right? But unfortunately, it's hard to get access to some of these factor premiums out there. So the next best solution is to just take, as opposed to just doing the market, if you want to do, smart beta factor investing, as opposed to just doing the market, you take factor bets within your long only exposure.
So that's better than just buying the market.
In general, I think it can be, yes, especially if the fees aren't that high, right? You always want to assess fees on.
Which would be the highest fees you would pay for a smart beta product to still be profitable for the investor?
Well, I think it depends. So this is where like a simple a phrase of what's called like active share, right, is something I think investors should be aware of, which is an active share just measures how different you are from the index. So, I will answer your question, but let me just explain this real quick. So active share can range from 0% to 100% for long only products, right? So 0% means you just bought the market. Effectively, the other product, its active share relative to the market it basically just owns all the market positions in the exact same weights. 100% means you have no overlap, right? So I think investors should look at active share of any smart beta product relative to the market. That would be the first thing I would do that. And here's why. Because let's just say you believe you have two products out there. One has an active share of 20%. One has an active share of 95%, right? So the 20% product, what does that mean? That means it's 80% the market, 20% a factor bet, right? And so you have to take this into consideration when you look at fees, because let's say you believe that the premium on a factor is 3%, okay? So in my 20% example, since I'm only getting 20% of factor tilt, I'm only at max going to get 20% times 3% or 60 basis points, right? Whereas my product that has 95% active share, if I believe the same premium, it's the exact same factor as 3%, I'm going to get like above around 2.75%, right? So when you're comparing fees on funds, I think you might want to look at what's called the active share as well, just to understand if it's taking like way different bets than the market.
Yes, but besides factor exposure, shouldn't we count also the geographical diversification benefits? So, for instance, maybe an index fund who deviates from a market cap weighted fund does not implement very well factors, but it still offers some diversification benefits because it is more diversified. So, for instance, an emerging markets Smart Beta ETF doesn't have 40% exposure on China, only 20%. So might still be better, even though it doesn't capture factors very well.
Yeah. So my answer on active share was specific to if you're like stuck in one market, right? Okay. So you're like, hey, I'm going to invest in the U.S. stock market, and I'm now going to assess smart beta only within U.S. The minute you go from like, as opposed to investing in U.S., I'm going to invest in international. Well, clearly, like their active share is 100%, right? Because they're completely unique markets taking completely different bets. And yes, in general, adding more different sources of return, like U.S., international, emerging, is good for a portfolio perspective.
Okay. In his latest memo, coming into focus, Howard Marks considers that the low interest rates environment will offer investors the lowest prospective returns in history. How would you balance between aggressiveness and defensiveness in such an environment, having the following options? A. Invest as you always have and expect your historic returns. B. Invest as you always have and settle for today's low returns. C. Reduce risk in deference to the high level of uncertainty and accept even lower returns. D. Go to cash and accept zero returns. E. Increase risk in pursuit of higher returns or even go into private equity markets.
Yeah, I mean, so for most people, the answer is probably going to be B, right?
Yes.
Which is, I think B. That what was B again? It was
B was settle for today's low returns and keep the same allocation.
Yeah. In general, that's unfortunately what a lot of people are going to have to do, right? Basically, I mean, in general, sticking with an investment strategy that you can stick with is probably like very important, right? I always go back to Mev Faber has a cool article called just Global Asset Allocation. It's like a small little white paper book he wrote. And one of the interesting factoids I found in that book is just, in general, a lot of asset allocations, like he went through all the different asset allocations from all these different investors, and they all ended up generally in the same area over like super long time periods, which just kind of highlighted like, if you stick with some model for super long time periods is probably a good investment strategy. Obviously, you want to make sure you're not doing anything crazy, right? Because all the people he looked at were smart, but they were doing it differently. So yeah, I mean, for most people, they're probably just going to have to accept lower rates of returns, because maybe if a unique opportunity arises where you can find something in private markets, good. But people have to remember that in private markets, you are accepting or you're generally looking for higher rates of returns because in a private market, you've given up diversification, right?
Yes.
Which means
And
you should
liquidity.
expect. Yeah, you're giving up a lot of things, diversification, liquidity. So all else equal, yeah, I'm going to expect a higher rate of return, but there's a high chance it's going to do really bad because I have absolutely zero diversification. If I need to get my money, I can't get it, right? So
this is also an important topic. How important do you consider diversification being today in a high correlation world across asset classes?
Well, what I'd say is there's high correlation across certain asset classes, but not all asset classes, right? So across global equities, yeah, there's going to be a super high correlation because in general, we now live in a global economy, right? So when March happened, it wasn't like one stock market or certain stock markets in the world were all up. They were all down. Like every single stock market, right? Even in like countries where they may, potentially control the stock market by buying stocks, they were still down, right? So no matter what happens, global equities were down. Then if you go on the bond market, right? Well, the riskier the bonds were, they were down, right? Because people were like, oh, crap, if there's like an actual economic impact, governments aren't going to do anything, possibly. At some point, people thought that was the case, right? The bonds with risk went down, but treasuries went up, gold went up, right? So there are, I would say, like within certain segments of asset classes, like global equities, yeah, you probably get little diversification benefit in crisis scenarios across those ones. You might get some, right? But you're not going to get as much. Whereas when you go from asset class A to asset class B, there can still be diversification benefits.
How do you reconcile the following two statements? A. We have skewness in equity markets and therefore deviating from a market cap weighted index fund will give you a highly skewed return profile. With B. We have long only factor tilted instruments which have constantly beaten the market since 1926. If it worked for factors to select some types of equities which might not have been affected by skewness, would it also work for cheaper areas using more geographical diversification, such as investing in the 12 cheapest countries based on CAPE?
Yeah, sorry, can you say that one more time on the questions?
So we know that we have skewness for equity markets. If we deviate from a market cap weighted index fund, we would have a highly skewed return profile. Even though from 1926 until present, investing in factors has constantly beaten the market. Can we find another cluster of equities which can still beat the market? Let's say not factors, maybe based on geographies or other type of criteria like population growth rates, or I don't know. I haven't researched this.
Gotcha. Yeah. So the skewness is that goes back to there's a paper, the Bessenbinder paper, which highlights that there's a very high negative skewness in stock returns. And basically a lot of the stock returns were driven by a very small subset of stocks, right? So then the natural question is, okay, so there's this weird skewness where like a very few amount of stocks, like if you don't invest in the market, very few amount of stocks actually account for all of the stock market gains. And on the same side, right, factors, which are definitely different than market cap weighting, did better. Well, I think the disconnect there is in the Bessenbinder paper, they're looking at just buy and hold returns to individual stocks over the entire lifetime, whereas factor portfolios are always being rebalanced, right? So what are you doing? You're constantly rebalancing in value every year into cheap stocks, right? We're not holding that value portfolio bucket for the entirety of every stock that ever goes into it. We will eliminate and get rid of some of these. So there's a difference in the way that portfolios are studied in those two.
That's very
Is what I would
interesting.
say.
So basically, it would be better to use a smart beta product which does automatically rebalancing every year than invest individually in, let's say, 12 ETFs from the cheapest regions. But if we don't rebalance, we lose some of the returns.
Well, specifically now tying it into, from an investing standpoint, one thing that I would say is, if you want to be, a value investor, and your suggestion was to just buy, 12 cheap markets, right? One thing that's true is you will have to rebalance that portfolio at some point, right? You could, in theory, buy and hold it, but who knows? Like maybe you end up putting some of your money into a super cheap country, and now it becomes expensive, right? Or there's some, it becomes, basically the government takes over the stock market, right? Like you're going to have to rebalance that. And so that's one of the nice things about smart beta products is they will be rebalancing your portfolio from time to time.
Okay, and now comes the next question. When do you consider it is a time to sell and partially reduce risk in the market? Is it wise to do that after equities increased a lot in the short term, let's say like the vaccine news, or it would be attributed to market timing? But then again, if you never sell to manage your positions, you would never register either a loss or a gain. Do you think that value cost averaging works better than dollar cost averaging? And another question, if there is any risks for smart beta ETFs to be arbitraged away, the risk premiums. There are people who say that in an efficient market, it might be this risk also.
Yeah. So the first question is on market timing, and on that, I'd say it really is like there's no great answer on that, right? Trend following is one attempt to time the market, whereby if trends are positive, you get in. If trends are negative, you get out. The downside to market timing is it can fail for long periods of time, right? Like basically since 2009, market timing has failed across almost every asset class, save commodities, which actually had a super large drawdown, right? So market timing is going to lose by definition a lot of times, and that can become behaviorally hard. So for most investors, I'd say on market timing, the default should be, just stay invested and diversify. Like if you have certain cash flow needs, like figure out other ways to answer that. Now on factor premiums being arbitraged away, that question it goes back, I would say, to two things. One is why do you believe that the premium exists, right? So if you believe the premium exists due to risk, which is kind of the femme French argument for size and value, right? And even for some of their new factors, if you believe it's for risk, then it would only be arbitraged away if investors were willing to take on more risk and receive no additional return, right? And in general, in efficient markets, we wouldn't think that that's the case, right? Because if you're taking riskier bets, you expect higher returns. So then on the but within factors, there's not just the risk argument, right? There's also the behavioral side, and on the behavioral side, they believe that factor premiums exist because there's basically market inefficiencies. There's kind of idiots out there that are causing these behavioral biases to occur. But the second part is there's also people that, from the behavioral side, you have to have idiots in the market, but then you also have to have what's called an arbitrage constraint, whereby there's reasons, though, even though there's idiots, money won't arbitrage away these idiots, right? And so for that argument, if you believe that factors are driven by behavior, two things could possibly happen. One is all the dumb investors go away, right? Which probably, we could argue maybe that did happen, maybe that will happen, but who knows? That's hard to figure out. And then the second thing is there an arbitrage? Is the limits to arbitrage still there? And I'd argue for, like, you can look at value investing, right? It's like you just talked about, the long short funds, which are going long value, short growth, they're closing, right?
Yes,
And they're closing, which highlights that people can't hold this trade, right? Like, in theory, that's the trade you should hold, and people are pulling their money from it. So, again, it's super hard to identify and give a perfect answer as to whether or not it'll be arbitraged away, but at least it's ways to think about how it would happen.
Okay. Considering the current valuations, especially for the US equity market, and the fact that the interest rates may stay low, do you think for the foreseeable future we can reach a cape of 50, let's say, for the US market? Would that make sense?
I don't know. If we did that, I would get maybe a little concerned if we had a cape of 50. That would be 5-0, right?
Yes. Also, in my country, many believe that you should simply buy more on corrections to increase your potential return and reduce drawdown. Is this an accurate statement, or using a short volatility strategy can be harmful for one's portfolio, being similar to leverage and increasing risk without guaranteeing return? Because A, if valuations worsen, don't we actually buy at more expensive prices? And B, if the market continues to decline, don't we actually risk getting out of money? Nicholas Rabener considered there is no price-based mean reversion, and survivorship bias does not help us in the long term.
Yeah, I mean, there's a lot of assumptions you need to make to ascertain whether or not that, like, the correct answer there is right. So, like, for example, right, let's just look at March of this year and talk about that strategy in March of this year. So, in theory, right, if let's just say there's no vaccine, no stimulus coming in, it could be the case that the earnings in the S&P 500 went from, I think it's like 180, but let's just say $200 a share down to 100, right?
Uh-huh.
In which case, if earnings got cut in half and the market's only down 25-30%, you could make an argument you've now bought the market at a higher multiple of earnings, right? Now, if you assume, which again, this is the difficult part of investing, right? If you assume that there's going to be that quick reversion of earnings, right, and it goes from 200 back to 200, well, you just bought the market super cheap, right? But again, we don't know the future. So I think the hardest thing there is no correct, great answer to that question, because it also really does depend on what the future holds for the actual companies. So unfortunately, I can't give that to you. The one thing I'll say is looking at investor behavior, if you have two options, one is you're just going to invest, $500 every month into equities or something like that, or the other one is you save your money, wait till the market drops, and then you buy. I would be it's probably more likely the case that the person that has it on automatic $500 is always going to do it, and they're not going to think about it, and they're going to be invested. Whereas the person who waits, well, now the market's down 10 and they're like, well, wait a minute. What if I wait till it's down 20, right? And then when it's down 20, maybe they invest, but maybe the market bounces back and now it's only down 5 and then they don't invest, right? So in general, I think the behavior becomes important. So
regarding what you mentioned about basically investing constantly, so doing dollar cost averaging, there is a research paper from Vanguard saying that lump sum investing is considered to win against dollar cost averaging in 2 out of 3 cases based on a large sample size. But if we take into account that we have only one single shot to invest all our money and go all in with ace pre-flop, let's say, with a lot of equity, right? And we can get unlucky and lose a lot of money rapidly. Isn't it more prudential to invest via dollar cost averaging for the long term, even though we might get lower returns, than lump sum investing?
Yeah, and again, so I mean, I've read that paper by Vanguard a couple of times, and effectively, what they're looking at is they're saying, hey, you have decent amount of money, you either invest it all today, or you invest it, over the next, certain time period, right? And in general, what happens is equity markets go up, and so if equity markets go up, and you have created what's called a cash drag because you didn't invest your money, well, of course, lump sum investing would have won on average, right? Which is why they get 2 out of 3. Now, the issue becomes you do have these scenarios where equity markets can have pretty severe drawdowns, right? So you have 2000, 2008, March of this year. So if you had put all of your money in on March 1st of 2020, you would have lost to a dollar cost averaging investor probably, right? That had decided to do it over the next 6 months, right? Because they would have been able to buy at much lower levels for the next couple of months, right? So what I generally tell people and investors is to pick the option that they can behaviorally live with, right? So if you're a person that's like, you know what, I'm just going to go for it, then go ahead and do it. But if you're not, which would be lump sum investing, if you're not, make sure you minimize your biases by setting up like an automatic investment over the next year. Just say, look, I think equity markets might be expensive here, but I don't want to miss out. So over the next year, I'm going to invest 1/12 every month, right? Like that's a way to think about it.
Yes, and without trying to make market timing, should you still adjust your risk into the markets based on how expensive are the markets and how large or small are the risk premiums? So if you are not compensated for getting risks, should you get those risks or maybe wait for better times, like Mark says?
Well, again, as I said, you can wait, but the problem is you might, like I know people that have been waiting since 2009 for equity markets to get cheaper, right? And if you waited for 11 years, you just missed out on a lot of returns. So that's always the downside, right? But again, like going back to one of the first questions we talked about, just look at current CAPE, or let's just look at PE in the US, right? Let's just say it's 25. I think it's in between 20 and 25. So on an earnings yield basis, it's 4 and 5%, right? Is it reasonable to think that that's going to do better than 75 basis points on 10-year treasuries over the next decade? The answer is probably yes, right? And so what I'd say is, you do want to assess where the market is, but I think sometimes if you're scared about it being high, then just dollar cost average over the next year or two. So.
Yes, that was another question. What rational expectations should we have for the next decade, given that when stocks were expensive, so with a CAPE above 25, the median 10-year annual compound total return from historical PE deciles 1926 to date was 4.1%. And what are your views for the performance of global equities in 2021? Are we going into a reflation trade or not?
Yeah. So here's what I'd say. The simplest back of the envelope way that anyone can look at expected returns is to just take like the PE multiple and do the inverse, right? Because that's basically telling you stocks. So again, if you're trading at 20 times earnings, that is basically a 5% earnings yield. And so if companies do nothing for the next 10 years and valuations don't change at all for the next 10 years, right? The return on equity of these firms is about 5%, right? So that's like the simplest back of the envelope calculation you could do. So if you did that, what you'd see is US is around 4 or 5%. International is around 6 to 8%. Emerging's around 7 to 8%. 7 to 9%, maybe even higher, right? Now, on international and emerging, you have to then make some default assumptions on from a U.S. perspective, but from there, you have to make some default assumptions on like FX conversion, right? So that'll be either a tailwind or a headwind. And if you assume it does zero, let's just assume that for simplicity, in general, that's what I would say is the simplest way that an investor can default come up with a quick back of the envelope, what can I maybe expect? So in the US, expected returns are much lower than they were in the past.
Do you consider that in the current market environment, the simplest and most effective way for retail investors to increase the probability of getting a high expected return from the equity markets for the next decade would be to simply use a smart beta long only factor tilted ETF for emerging markets, which already uses geographical diversification, automatically rebalances across regions, includes factors at least partially, and reduces volatility at portfolio level, being more easy to buy and hold for the long run technically and emotionally?
Well, yeah. Sorry, maybe summarize that question. What's the goal?
Um, if the simplest way to reach your desired return for the next decade into this environment would be to simply invest in a smart beta emerging markets ETF.
Gotcha. Yeah. So what I'd say is, given my quick back of the envelope return expectations, EM generally from that simple back of the envelope calculation appears to have higher expected returns, which is good. Smart beta is just a way to, as opposed to simply using market cap, it tilts the portfolio towards factors. So I think it's a reasonable approach. I mean, no one knows if it's going to be the best approach, but I think that's definitely a reasonable approach to use for investors.
Mhm. And how would you assess the current risk return profile for a global market cap weighted index fund for someone who has 30 years until retirement and uses a buy and hold DCA strategy? And also, how would you make sure to have that desired safe withdrawal rate when you reach retirement in the current market environment? Which would be your asset allocation for retirement years?
Yeah, well, I mean, there's no great, like, that's why financial advisors exist. Obviously, because from person A to person B to person C to person D, there's going to be different required withdrawal rates, different goals, different objectives, different amounts that they maybe want to leave towards family or just use it all up, right? So that's all going to vary. What I'd say is, in general, like U.S. equities, expected returns are probably lower than other asset classes. One thing that's an interesting little tidbit is on bond asset returns. If you're buying like government bonds, especially in developed economies, in general, the starting interest rate in which you invest is generally your next 10 years nominal return. Right. So what that means is for U.S. investors buying U.S. Treasury bonds, if the current yield is 1% nominal, I can tell you if you have a 60-40 portfolio where 40% is Treasuries, on this 40%, you're only going to get 1% nominal for the next decade, which generally is going to bring down overall portfolio returns.
What do you think about Romanian treasury bonds? They are offering 2% return at euro for a 5 years holding. And for a retail investor who doesn't pay anything on profits, doesn't have any costs, um, how risky it is? We're in the middle between investment grade and junk as a country. But still, there are no currency risks, no costs involved, no taxes. So, and we get 2% the highest return in Europe for euro.
I don't want to speak out of turn. I'll probably defer on that question because I'm not 100% certain. The only thing I'll say is, just with any bonds, right, in general, the simple way to look at bond returns is effectively, you have like your default rate, and then the riskier the bond becomes, the more you expect higher return for that yield. So again, it just becomes a risk reward trade-off. So, but I don't know if I have a great answer on that one. Sorry about that.
Okay. We have lived in a period of prosperity and secular growth. How probable do you think it is to enter a new period of secular decline where both equities and bonds will be affected? Is there any safe haven for investors in such an environment? Is there any chance once again to capture that active long volatility. Would maybe a higher cash allocation be suitable for such challenging times with decreasing bond yields and risk premiums and elevated volatility in the markets?
Sorry, can you summarize that question? Just
If we enter a secular decline, we had a secular bull market on bonds from 1980s, I guess, and also
Yep.
equities, especially large cap growth stocks have earned a lot because of this low interest rates environment. What will happen with the asset classes if we enter a secular decline? What kind of safe havens do we have as investors, or what can we do?
Yeah, so you're talking about kind of like bond yields rising and equities not doing too well?
Yes.
Is that the scenario you're describing? Yeah. I mean, unfortunately, just like bringing down interest rates like across everything, that's generally like especially by central governments, that's generally like the default return rate that investors can expect. So all that means is unfortunately, returns have been brought down across the board. So, yeah, I mean, if bond yields are rising and stocks are doing poorly, unfortunately, you'd have to have some sort of like diversified other alternative investment, which again, those are few and far between and hard to come by. So I'm not certain if there's a great answer there.
Or
right?
maybe bonds not rising but simply kept. I mean, how low can the yield go? For the eurozone, it is negative for a 30-year period holding. So
Yeah, I mean, like one potential strategy that could work in there, but again, not guaranteed, would be just like trend following, right? Because trend following can help you possibly, if yields started going up, you could get out and then you would get back in when interest rates are much higher, which is good, right? Same thing on equity. So trend following is like a simple way to add as like a potential sleeve of portfolio that could potentially help in that scenario.
But how? Because we don't have access in which its format at any products for trend following.
Yeah, well, trend following is just pretty simple. It's like if it's trending up, you stay invested. If it's not, you get out. But again, for most investors, unfortunately, you'd probably have to just assume slightly lower rates of return. So.
If you were to construct a CAPE value portfolio of individual country ETFs, which would be the best methodology? Use data from Star Capital to construct a relative valuation-based portfolio by simply selecting the countries with the lowest current CAPE, or you somehow take the current CAPE of each country and compare it with the historical one to avoid the value traps.
So specifically building it with just country indices, correct?
Yes, and also it would be challenging with rebalancing because, as you said, if you don't rebalance and simply buy and hold, you would have a different result than a smart beta ETFs who does rebalance automatically.
Yeah. Yeah, I mean, investing in cheaper countries generally has been a good bet historically, but it doesn't work all the time, right? Like the past 5-10 years, that's been lagging. But I mean, investing in cheap countries on CAPE, I think, is generally a good approach. A simple smart beta product that invests always in cheap countries and buys cheaper stocks within cheaper countries, that also works as well. But it takes out some of the work of having to do the rebalancing from year to year.
Which one do you think is better between the smart beta product and the 12 index funds individual country ETFs?
I generally would probably defer towards like a smart beta, whereby you're kind of tilting within each country to cheaper stocks. Because it can be the case that like a country's cheap, but some of the stocks you're investing in are expensive. So, but that's just I would say maybe bias of like fundamental, looking at the stocks from the bottom up. standpoint.
Yeah, and also if you look at Turkey, Turkey is cheap, but the currency had a lot of issues this year. I have been invested in Turkey, and if you use a short volatility strategy in such volatile instruments, you can get a very high exposure on them because if they decline a lot and double their decline due to the forex decline, then you get to hold a lot of Turkey.
Yeah. Well, and that's a reason, the smart beta ones generally will invest in like 10 or 12. So you get some diversification across countries as opposed to having one. And even if you invested in 10 individual country ETFs, a lot of times the behavior comes in where you're like, oh man, this one's down so much. Right. And you have issues. So, hey, and Victor, I do have to hop off in like 5 minutes. Sorry. But
The last question, would you buy on correction on individual equities where, as Peter Lynch says, how much can you lose? Everything, because if a stock goes to zero, you can lose all your money. Would you use the same strategy for individual equities or not? And last question, what do you think of Bitcoin and cryptocurrencies? Because it is a insanity in my country. Everybody speaks about this.
Yeah. So the first one was, would I buy individual equities on dips?
Yes.
I mean, currently, I just generally, if I did want to buy on a dip, it would probably just be like diversified portfolio. But that's also, I'm in a scenario whereby my career, my family's money, etc. Like, we're tied to the market so much that I don't necessarily need to take bets on individual stocks. Because I'm already tied to a kind of unique thing. But for individuals, from time to time, I think it's not like a horrible idea. I generally would say, have like 95% of your money in diversified, like market cap type, at least simple portfolios. And then on the other 5%, if you want to maybe buy stocks, that's okay. Because as we talked about earlier, we do know ex ante that a lot of the stock market gains are driven and delivered by very few stocks. So, I think it's good in general if you want to put some of your money in individual equities, but I still would recommend generally baseline diversification because, that's another interesting thing from that study, which is that while very few stocks do well, it also highlights that the majority of stocks literally are worse than investing in cash.
Yes.
And so that's why you need to buy the market, which is diversified, right? Mm-hmm. And then on Bitcoin, Bitcoin, it's a interesting thing. I guess the premise or the theory for like investing in it or holding it is it could potentially be like the new gold, like digital gold, right? And it probably does have some interesting hedge ability. Like, who knows if there's like a war in a country and people are trying to get their money out, there could be like a huge spike in demand and trying to get their assets into that, because at least they could transfer that to another country, right? Like, in the US, we just kind of take for granted, like, capital, you're allowed to move. Obviously, you can't do anything nefarious with your capital, but you can just move it from place to place. But in other countries, there are a lot of countries across the world that restrict capital movement. Like, you can't take your money out of the country. That's illegal, right? So in such, I just think Bitcoin is an interesting asset class that could potentially be like a super hyperinflationary hedge, in my opinion. Which, again, I'm not a crypto expert, but
although the market capitalization is still low and central banks do not use currently Bitcoin, rather prefer gold. And also, do you really think that inflation is a risk for capital markets in the next decade?
No, I don't. Oh, famous last words. So probably not. Right? Probably not. But there's always just, I think, it's like an edge case thing, right? Like who knows if there's like a war that breaks out in a random country, like a civil war or something. Like it's just hard to predict. Like I had no clue there was going to be a pandemic going into this year, right? And the past, so yeah, like who knows? Like again, it's crypto, like Bitcoin specifically, is kind of like gold, right? It's like, why would you hold gold, right? You just believe that there's going to be inflation, right? Like it's
with gold you have currency risk on dollar because the
yeah,
price is expressed in USD.
Yeah, well, that's true. But yeah, so yeah, I don't know if I have a great answer on crypto, but I do think it's an interesting asset class, if nonetheless.
At least uncorrelated or not correlated with the main return streams. Although I don't think it is a safe asset class to hold for the long run.
No, it's going to have super high volatility, and it actually is like people say it's not correlated to equities, but if you actually look, like it kind of peaked like a couple of years ago, right when equity did peak, and then equity went down and crypto went down. This year in March, right? So an interesting thing is just to look at like equity crashes and what happened in crypto. So this year in March, it's not like when this U.S. stock market was down 35-40%, crypto was up because gold was up.
Yes, I
right.
remember.
But crypto was down like 70%. So it was down a lot. So it's a unique asset class, and I don't know if there's a great answer.
People also talk about it because it has an asymmetric risk-reward profile, or at least this is what I heard. Now I don't know.
Well, that's the assumption on it, right? The assumption is, and it's probably true, the assumption is it's going to zero or it's going high, right? So it's kind of like you kind of know the bet you're taking.
Yes, but it's a speculation because Warren Buffett says that the first rule in investing is never lose money. So if you can assume that it can go to zero, then it's not a good investment, right?
Yeah, that's one way of thinking about it. Yep. So.
Okay. Thank you very much, Jack Vogel, for accepting my invitation. It was a very interesting Q&A session, and I had a lot of questions from me and also from the community because they know I will make this interview. And hopefully we will have a better 2021. And by better, I don't know what I mean, because for some people, if markets decline could be good. If markets go up, equities become more expensive. But hopefully we will have the chance again to talk next year as well.
Yep. All right. Well, have a great day. And thanks for having me.
Thank you very much, Jack. Have a nice day as well. And thank you for accepting my invitation.
You're welcome. I'll see you, Victor. Bye.
Bye-bye.